Question 22. A firm has purchased computers to the value of $40,000. These computers were purchased on credit with the amount owing to be paid next year. At the end of the current year, the amount owing for the computers will be classified as A, an asset, B, a liability, C, revenue, or D, an expense. We're just looking at the amount owing for the computers, not the computers themselves. So that's going to get rid of A. It's not an asset. The amount owing is not the asset. It can't be C. There's no revenue here from the computers. The business isn't the one that sold them. D, it's not an expense, the amount owing for the computers. The expense in using them would be, we call that depreciation, which is covered later in the course. So really we're going to get down to option B, which is a liability. To answer this question, we want to look at the definition of a liability. It says a liability must be a present obligation. There must be a legal obligation to pay another party, and that is true. We bought computers on credit for $40,000, so the business owes another party $40,000. That's a contract. You can't get out of that. There's a legal obligation, so that's true. Secondly, a liability must arise from a past event or transaction. In this case, that's true. It was a transaction. The business went to a supplier. The supplier gave us computers, and in effect, we gave them an IOU saying we will pay you at a later date. So that is also true. And lastly, it must result in an outflow of future economic benefits from the entity. That is also true. At some point in the future, the business will pay back the supplier for the computers, $40,000 cash in the future. That is an outflow of economic benefits. So all three criteria are true. So the amount owing for the computers would be classified as B, a liability.